What if I told you there's a hidden pattern that has been quietly orchestrating the rise and fall of entire economies for over 2 centuries? A cycle so precise that it predicted the crash of 1929, foretold the disaster of 2008, and is now pointing directly at 2026. Most people think financial crashes happen randomly, that they're unpredictable acts of economic chaos. But they're wrong. There's a secret rhythm pulsing beneath the surface of global markets, and those who understand it have been preparing while everyone else remains blind to what's coming. The year 1929 wasn't just a bad year for the stock market, it was the beginning of the Great Depression, the most devastating economic collapse in modern history. Unemployment soared to 25%, businesses shuttered overnight, families lost everything. Then came 2008, and the pattern repeated with chilling accuracy. Banks collapsed, mortgages evaporated, and millions watched their life savings disappear. But here's what almost nobody realized at the time. Both crashes followed the exact same blueprint, a blueprint that was written decades earlier by a Russian economist whose discoveries were so dangerous that Stalin had him executed. The man's name was Nikolai Kondratiev, and he uncovered something that governments didn't want you to know, something that reveals the true nature of how capitalist economies rise and fall. His work was buried, his theories suppressed, and his life cut short because he dared to expose the mechanical precision with which economic cycles operate. But his discoveries lived on, hidden in academic papers and whispered about in the circles of those who understand how money really works. Today, that same pattern is pointing toward 2026 with the kind of mathematical certainty that should terrify anyone who lived through 2008. The signs are everywhere if you know where to look. The debt levels, the asset bubbles, the political tensions, the social unrest. It's all happening again, following the script that Kondratiev decoded nearly a century ago. And this time, the crash could be worse than anything we've ever seen. Let me take you back to where this story really begins. The 1920s were supposed to be the decade when America proved that prosperity could last forever. They called them the Roaring Twenties for good reason. Cities were exploding with growth as rural Americans flocked to industrial centers seeking their fortune. Stock prices climbed relentlessly upward. Politicians promised continued prosperity. The newspapers declared that the age of boom and bust was over, that American ingenuity had finally conquered the business cycle. Sound familiar? It should, because the exact same narrative played out in the early 2000s. Housing prices could only go up, they told us. The internet had created a new economy where the old rules didn't apply. Alan Greenspan spoke of a great moderation, a time when recessions would be shallow and brief. Politicians from both parties celebrated the triumph of free markets. The economy was flourishing, and optimistic leaders predicted it would continue forever. But underneath all that confidence, the same forces were building that had destroyed economies for centuries. In the 1920s, it was speculation in stocks and easy credit that inflated asset bubbles beyond any reasonable measure. In the 2000s, it was speculation in real estate and derivatives that created bubbles so massive they nearly brought down the entire global financial system. Different assets, same pattern. Different decade, same outcome. Here's what most people missed then and are missing now. These weren't random events. They weren't caused by greed or stupidity or bad luck. They were the inevitable result of a cycle that operates with the precision of clockwork, a cycle that Nikolai Kondratiev identified by studying hundreds of years of economic data. Kondratiev discovered that capitalist economies don't grow in straight lines. Instead, they rise and fall in long waves lasting approximately 50 to 60 years. Each wave consists of 3 distinct phases: expansion, stagnation, and recession. During the expansion phase, new technologies emerge, productivity soars, and wealth accumulates. But expansion always carries the seeds of its own destruction. Asset prices become disconnected from reality. Debt levels reach unsustainable heights. Inequality grows to dangerous levels. Then comes stagnation, a period where growth slows, and the contradictions built up during expansion become impossible to ignore. Finally, recession arrives like a forest fire, burning away the excess and clearing the ground for the next cycle to begin. It's not personal. It's not political. It's simply the natural rhythm of how capitalist systems operate. The terrifying precision of this pattern becomes clear when you look at the numbers. The Great Depression began in 1929. Exactly 54 years later, the savings and loan crisis hit America in 1983. 25 years after that, the financial crisis of 2008 devastated the global economy. And now, 18 years later, we're approaching 2026 with the same warning signs flashing red across every indicator that matters. But Kondratiev wasn't the only one to crack the code of economic cycles. There's another pattern, running parallel to his long waves, that has proven even more precise in its predictions. It's called the 18-year real estate cycle, and it was decoded by a British economist named Fred Harrison, who did something most academics never bother to do. He tested his theory by predicting the future. In the 1990s, Harrison used his 18-year cycle to predict that property markets would crash in 2008. He didn't just say there might be problems. He specified the year, the cause, and the severity. When 2008 arrived exactly as he had foretold, Harrison became one of the few economists who had actually earned the right to make predictions about what comes next. And what comes next, according to Harrison's model, is 2026. He has stated with the same confidence that allowed him to predict 2008 that house prices will peak in 2026, marking the end of the current cycle and the beginning of a significant economic downturn. His track record suggests we ignore him at our peril. The convergence of Kondratiev's long wave theory and Harrison's real estate cycle creates a picture that should concern anyone who understands how these patterns work. Both cycles are pointing toward the same moment in time, the same year when the accumulated excesses of the current expansion phase will finally demand their reckoning. But unlike 1929 or 2008, this crash is approaching at a time when governments have already exhausted many of their traditional tools for fighting economic downturns. Interest rates have been near zero for years. National debts have exploded to levels that would have been unthinkable just decades ago. The very institutions that were supposed to prevent another Great Depression have instead created conditions that could make the next crash even worse. The Federal Reserve, the institution created in response to the financial panics of the early 1900s, has pumped trillions of dollars into the economy since 2008. That money didn't disappear. It inflated asset bubbles in stocks, bonds, and real estate to levels that make the bubbles of 1929 and 2008 look modest by comparison. When those bubbles pop, and the cycles suggest they will pop around 2026, the damage could dwarf anything we've seen before. What makes this particularly dangerous is that most people have no idea these cycles exist. They've been trained to believe that crashes are unpredictable, that no one could have seen them coming. But that's exactly what they were saying in 1929. That's what they insisted in 2008, and it's what they're repeating now, even as the same patterns unfold with the same mathematical precision that has governed economic cycles for over 2 centuries. The question isn't whether the cycle will complete itself. History shows us that it always does. The question is whether you'll be one of the people who sees it coming or one of the many who gets caught completely off guard when the music finally stops. The signs are hiding in plain sight, scattered across economic indicators that most people never bother to examine. But when you know what to look for, the pattern becomes unmistakable. Take the yield curve, a technical indicator that sounds boring but has predicted every single recession since 1968 with perfect accuracy. When long-term interest rates fall below short-term rates, creating what economists call an inversion, recession follows within 12 to 18 months. No exceptions, no false signals. The yield curve has been inverted longer and deeper than at any time except the early 1980s. And historically, the longer and deeper the inversion, the more severe the recession that follows. If this pattern holds true, we're looking at an economic contraction that could begin as early as late 2024 and reach its peak destruction sometime in 2026. But the yield curve is just one piece of a much larger puzzle. The Salm rule, discovered by economist Claudia Salm, shows that recessions typically begin when unemployment rises at least half a percentage point above its recent low. Current forecasts project unemployment climbing to 4.6% by September 2026, with job growth slowing to less than half its current pace. The labour market, often the last indicator to show weakness, is already flashing warning signs that most economists are choosing to ignore. Then there's the debt. Oh, the debt. The United States government is now spending more on interest payments than on defense, education, or infrastructure combined. The national debt has exploded from $8 trillion in 2008 to over $33 trillion today. That's not just a number on a spreadsheet. That's a financial time bomb that grows larger with every passing day. And when interest rates rise or confidence in Treasury bonds wavers, the explosion will be felt around the world. Corporate debt tells an even more frightening story. American companies have borrowed money at near zero interest rates for over a decade, using cheap credit to buy back their own stock and inflate their share prices. When that debt comes due for refinancing at higher rates, companies that looked profitable on paper will suddenly discover they can't service their obligations. Bankruptcies will cascade through the economy like dominoes falling in slow motion. But perhaps the most alarming indicator is one that few people understand: the commercial real estate market. Office buildings, shopping centres, and apartment complexes purchased with cheap money are now worth less than the mortgages secured against them. Banks across America are sitting on hundreds of billions of dollars in commercial real estate loans that will never be repaid. When those losses finally surface, they'll trigger a banking crisis that could make 2008 look like a minor correction. The parallels to previous cycles aren't just statistical, they're behavioral. Just as in 1929 and 2008, today's financial leaders are displaying the same overconfidence, the same dismissal of risks. Treasury Secretary Janet Yellen insists the banking system is sound. Wall Street analysts predict continued growth. They're reading from the exact same script that their predecessors used before every major crash in history. And just like their predecessors, they're missing the forest for the trees. They see individual problems as isolated events rather than symptoms of a system approaching its breaking point. A regional bank failure here, a commercial real estate problem there, inflation that won't quite behave as expected. Each issue gets explained away, minimized, or blamed on temporary factors. But when you step back and view them through the lens of cycle theory, they form a coherent pattern that points towards systemic collapse. The international dimension makes this cycle potentially more dangerous than any before it. In 1929, the global economy was far less interconnected. A crash in New York took months to spread to London or Tokyo. In 2008, globalization had accelerated the contagion, but many emerging markets were still relatively insulated. Today, the world economy is more integrated than ever before, with supply chains, financial markets, and currencies tied together in ways that amplify rather than dampen economic shocks. China's property bubble dwarfs anything America experienced before 2008. Europe's banking system remains fragile, propped up by central bank interventions that have masked rather than solved fundamental problems. Emerging markets have borrowed heavily in dollars, creating currency mismatches that will become lethal when the dollar strengthens during the next crisis. When the cycle completes itself in 2026, the reverberations will be felt simultaneously across every continent. What makes this particularly insidious is that the very policies designed to prevent another Great Depression have actually made the next crash more likely and more severe. Quantitative easing, zero interest rates, and massive government stimulus have created moral hazard on a scale never before seen in human history. Banks know they'll be bailed out, so they take greater risks. Corporations know credit will remain cheap, so they lever up beyond reasonable levels. Investors know central banks will intervene during any serious downturn, so they bid asset prices to ridiculous heights. This artificial suppression of normal market corrections has prevented the small fires that would normally clear out economic deadwood before it accumulates to dangerous levels. Instead, we've built up a massive pile of financial kindling that's just waiting for a spark. When that spark finally comes, probably sometime around 2026 if the cycles hold true, the resulting conflagration will be unlike anything the modern world has experienced. The technology sector, which has driven much of the recent economic growth, shows all the classic signs of a late cycle bubble. Artificial intelligence companies with no profits trade at valuations that make the dot-com bubble look conservative. Venture capitalists throw money at startups with business models that make no economic sense. The same euphoria that characterized the railroad boom of the 1840s, the stock speculation of the 1920s, and the internet frenzy of the 1990s is playing out once again in Silicon Valley and beyond. Even more concerning is the social and political context in which this economic cycle is unfolding. Previous crashes occurred during periods of relative social stability. Today's America is more polarized than at any time since the Civil War. Trust in institutions has collapsed. Political violence is becoming normalized. When the economic crisis hits, it won't just be a financial event. It will be a social and political earthquake that could reshape American society in ways we can't fully predict. The international political situation adds another layer of risk that didn't exist during previous cycles. Rising tensions between the United States and China echo the great power rivalries that preceded both world wars. The war in Ukraine has already disrupted global energy and food markets. The Middle East remains a tinderbox that could explode at any moment. Military conflicts have a way of accelerating economic cycles, turning financial crises into full-scale depressions as resources are diverted from productive uses to destruction. Yet despite all these warning signs, despite the mathematical precision with which these cycles have operated for over 2 centuries, most people remain completely unprepared for what's coming. They've been lulled into complacency by 15 years of artificial stability maintained through unprecedented monetary and fiscal intervention. They believe that central banks have conquered the business cycle, that modern economic management has made severe recessions obsolete. They're about to learn the same lesson that previous generations learned in 1929 and 2008. No amount of human cleverness can permanently override the fundamental laws that govern economic systems. The cycles don't care about your political beliefs, your investment strategy, or your faith in central banking. They operate according to principles that are as immutable as the laws of physics, and they're about to reassert themselves with devastating force. The most chilling aspect of cycle theory is how it reveals the illusion of control that pervades modern economic thinking. Every generation believes it has finally mastered the mysteries of prosperity, that it has developed tools sophisticated enough to prevent the boom-bust cycles that destroyed previous eras. The economists of the 1920s thought they had figured it out. The Federal Reserve chairmen of the 2000s were certain they had learned from past mistakes. Today's financial leaders display the same arrogance, the same certainty that this time really is different. But the cycles don't distinguish between smart people and stupid people, between good intentions and bad ones. They're a force of nature, as inexorable as gravity or entropy. When a system accumulates enough imbalances, those imbalances must be corrected. The only question is whether the correction happens gradually through small adjustments or violently through complete collapse. Current economic policy has chosen violence. By suppressing normal corrections for over a decade, by inflating asset bubbles to unprecedented sizes, by accumulating debt loads that would have been unimaginable to previous generations, we have guaranteed that when the adjustment finally comes, it will be catastrophic. The longer you hold a beach ball underwater, the more explosive its rise to the surface becomes. And the beach ball is starting to slip from our grasp. Corporate earnings are increasingly dependent on financial engineering, rather than productive activity. Stock buybacks funded with borrowed money have become more important than actual business growth. Real estate prices have disconnected completely from underlying economic fundamentals. The entire structure of modern finance has become a house of cards, balanced on the assumption that interest rates will remain low forever, and that governments will always intervene to prevent serious downturns. But governments themselves are running out of ammunition. The Federal Reserve's balance sheet has expanded from less than $1 trillion before 2008 to nearly $9 trillion today. Interest rates have been at or near zero for most of the past 15 years. Government deficits have exploded even during supposedly good economic times. When the next crisis hits, policymakers will discover that their traditional tools have already been exhausted fighting the last war. This is what makes the approaching cycle completion so dangerous. Previous crashes occurred when governments still had substantial fiscal and monetary firepower in reserve. The Federal Reserve could cut interest rates from 5 or 6% down to zero. The Treasury could increase spending without immediately triggering concerns about debt sustainability. Banks had enough capital reserves to absorb significant losses without collapsing. None of those safety nets exist today. Interest rates are already near zero, leaving little room for cuts. Government debt is already at levels that are straining credibility. Bank balance sheets are stuffed with assets whose values depend entirely on continued easy money policies. When the cycle turns, as it inevitably must, the economic system will discover just how fragile its foundations have become. The human cost of this approaching reckoning will be immense. Millions of people who thought they were building wealth through their retirement accounts and home equity will watch those assets evaporate. Small businesses that survived the lockdowns of 2020 will face a credit crunch that makes those disruptions look mild. Young people entering the job market will find opportunities scarce and prospects dim. Retirees living on fixed incomes will discover that their carefully planned financial futures have been destroyed by forces they never saw coming. Yet there will also be opportunities for those who understand what's happening. Every great economic cycle creates both destruction and renewal. The crashes of 1929 and 2008 wiped out fortunes built on speculation and debt, but they also created the conditions for new growth built on firmer foundations. The key is recognizing the difference between paper wealth and real value, between assets that depend on continued inflation, and those that retain purchasing power regardless of monetary conditions. History shows that the survivors of economic cycles are never the ones who trusted most in the system's promises of permanent prosperity. They were the ones who recognized fragility before it became obvious, who positioned themselves to weather the storm while others were still dancing at the party. They understood that in a world of fiat currencies and artificial markets, true security comes not from following the crowd, but from thinking independently about what actually holds value when illusions collapse. The next 18 months will be crucial for anyone who wants to understand where this cycle is heading. The patterns suggest that the initial phase of the downturn could begin as early as late 2024, with the most severe impacts hitting around 2026. But cycles aren't mechanical clocks that operate with perfect precision. They can be accelerated by external shocks or delayed by unprecedented interventions. What matters isn't the exact timing, but the recognition that the system is approaching a breaking point. Watch for the telltale signs that have preceded every major economic collapse in modern history. Credit spreads will widen as investors demand higher returns for lending to risky borrowers. Corporate defaults will accelerate as companies struggle to refinance debt at higher interest rates. Regional banks will face liquidity crises as depositors flee to larger institutions or government securities. Real estate markets will seize up as buyers disappear and sellers refuse to accept lower prices. Most importantly, watch for the moment when confidence breaks. Economic cycles ultimately aren't about mathematics or statistics. They're about human psychology, about the collective beliefs that hold financial systems together. When enough people lose faith in the ability of governments to manage the economy, in the safety of banks, in the value of currencies, the entire structure can collapse with stunning speed. That moment of broken confidence is approaching faster than most people realize. The cycles that predicted 1929 and 2008 are now pointing toward 2026, with the same mathematical certainty that has governed economic systems for centuries. The only question is whether you'll be prepared for what comes next, or whether you'll be another casualty of a pattern that has been hiding in plain sight all along. The secret isn't really secret anymore. The information is available to anyone willing to look beyond the headlines and examine the deeper forces that shape economic reality. But information without action is worthless. Understanding these cycles means nothing if you don't use that knowledge to protect yourself and position for what's coming. Because when the pattern completes itself, as it always has and always will, those who saw it coming will inherit the future from those who refuse to believe. History doesn't care about your comfort zone. It doesn't care about your retirement account, your mortgage payments, or your faith in the system. It operates according to patterns that are as old as capitalism itself, and those patterns are now converging on 2026 with the kind of mathematical precision that should wake up anyone who lived through the last two crashes. Nikolai Kondratiev died for revealing these truths, but his discoveries survived him. Fred Harrison staked his reputation on predicting 2008, and now he's pointing at 2026 with the same confidence. The yield curve, the Psalm rule, the debt levels, the asset bubbles, every indicator that matters is flashing the same warning that preceded 1929 and 2008. The cycle is completing itself whether we acknowledge it or not. The most dangerous lie you can tell yourself is that this time is different. That's what they said in 1929. That's what they insisted in 2008. And that's what they're repeating now, even as the same forces build toward the same inevitable conclusion. But you don't have to be a victim of patterns you didn't know existed. The question isn't whether the cycle will complete. History shows us it always does. The question is whether you'll be one of the few who saw it coming, or one of the many who gets crushed when the music finally stops. Because when 2026 arrives, and the pattern that has governed economic systems for over 2 centuries reasserts itself one more time, there will be no excuses left for those who refuse to listen. The clock is ticking, the cycle is turning, and time is running out to prepare for what's coming next.